You're welcome to the Economy and Politics Conversation. I'm Ottoabasi Abasiekong. This edition will discuss Nigeria's tax reform bills, understanding how VAT affects states. Joining us virtually for this program is Mr. Yomi Olugbenro, West Africa tax leader for Deloitte. It's great to have you, Mr. Yomi.
It's good to be on your show. Always a pleasure.
Thank you very, very much. Of course, to our viewers, the tax reform bills is a major discussion point. The Federal Government Tax and Fiscal Committee rolled out 4 bills, which is being deliberated in the National Assembly: the Nigeria Tax Bill, Nigeria Tax Administration Bill, the Nigeria Revenue Service Bill, and of course, the Joint Revenue Board Bill. But the major conversation today is on the value-added tax, the VAT. And we'll begin with Mr. Yomi on this issue as it concerns the states. The proposed VAT revenue sharing formula and implications for subnationals, that will be our first part of the conversation. But I'd like you first to tell us more about value-added tax. What is VAT? Because one of our commentators and analysts has raised that from his discussion with several people across the country, there's even need to understand what VAT is, comparing it to corporate income tax or even personal income tax. So what is value-added tax? And then you take us through this revenue sharing formula of VAT and implications for subnationals.
Right. Thank you so much. So generally, when we say tax, tax is an imposition on either the income or specific economic activity or transaction within the country. When that tax is charged directly on the individual that is paying it, whether as a limited liability company, a juristic person in name, or an individual, you say that is a personal tax, personal income tax. Now, but we also do have taxes that are charged on specific services or specific products and the consumption of those services. And VAT is an example of so. So value-added tax is a consumption tax, which means they are levied on specific service, specific product, and whoever buys those service or whoever consumes those specific products, the burden of payment or the burden of that tax falls on that individual. It is called value added because it's a multi-stage type of tax. So at every level of the economic activity, you have the VAT or the tax being levied. So the way it works is that if you buy, let's say the laptop that is, right in front of you there, and you are selling it, so at the point of purchase, because you are buying that item, you pay a specific, a rate of tax, currently the 7.5. Now, let's say, for example, you do some extra value adding. So maybe you created a casing, or an extra keyboard, to enhance the value, and then you sell it. When you are selling, you charge the same level of VAT to whoever is buying it from you, and then, for your own effort, because it's just on the value added, you claim the VAT you have paid at the point of purchase, the one that we call infill VAT. So that's typically how the VAT works, or how it is. Now, in the country, there is a type of tax that is also sometimes quite confused with value-added tax, which is the one we call the goods and services tax, the GST, or what we typically call sales tax. Prior to 1993, it was that type of tax that we have in the country, sales tax, and it was generally administered by all of the states, which is each of the states, which is essentially where this history of the tax being a sales tax, emanated from. But this tax was greeted by quite a lot of challenge because in its orientation, it was a value-added tax they had in mind, which is the one that allows you to claim input VAT and net it off, your output VAT, and only pay VAT essentially on the value added that you've done. So in 1993, the reforms happened, and we introduced what we currently practice, which is the value-added tax. And at that particular point, the law made the administration to be centralized. And so even though in principle, this is supposed to be a sales tax, it was administered centrally, collected by a central body, and then allocated to all the tiers of government. And so whatever VAT that is collected in the country as we speak, we will have the vertical allocation, which is the allocation among the tiers of government, i.e. federal, state, and local government, with the state government being the largest, beneficiary. 15% goes to federal government, 50% goes to the state government, and then 35% goes to local government, right? And then the states then shared, the state and local government, that is, share the portion that is, attributable to them using another revenue sharing formula, which is part of, the real debate, that this current bill has generated. So the current horizontal sharing formula, that is, how do states share it? Half of whatever is collected or that's accruable to states is shared on equality, so meaning that you divide it equally among all the states of the federation. 30% is based on population, so you use the official population census, to be able to allocate, and then 20% is derivation, i.e., the states where that VAT is generated from or is expected to have been generated from, share 20% among themselves. That's so, and I think this background that you have asked is very important for us to understand what's causing the issue as we speak. Now, what the status quo was with that arrangement, i.e., 20% being shared on derivation, 50% on equality, and 30% of population, is that many states felt that for many reasons, that system is not equitable. Why? They think this is a tax that should ideally be 100% accruable to the state because it is supposed to be a state tax. But for efficiency, for effectiveness, because of the complaint that taxpayers are having over the burden of administering taxes by multiple states, we say, let's centralize it. So those states said, no, we don't think 20% based on derivation is fair. That's the first argument. And you recall states like Lagos State, state like Rivers State took, the federal government to court, and they actually won.
Yes, we discussed Rivers State last time. Yeah, exactly.
So this is supposed to be our taxes, and so we should administer it. So there's actually a case pending at the Supreme Court now, which, if, for example, that could throw all of this conversation we're having out of the room. If that decision gets passed, that states are the one entitled to administer VAT, it means every state will charge VAT and will keep whatever they have collected. So all of this conversation around what percentage is equitable, will be lost or might be lost. All right. So that's on the first part. Second part is that some states also, challenge the basis of arriving at the derivation data. Assuming it's even 20%, what exactly is derivation? Derivation is supposed to be based on where the services or the product were consumed. For some lopsidedness in the administrative, mechanism for the current law, the derivation rule isn't, actually properly administered. So what we currently call derivation, based on the current practice, is based on the state where those VAT returns were accounted for, like, where those VAT returns were filed. And that's where people talk about the headquarter effect, and all of that states where, companies have their head offices. That's where the VAT return is filed. And because of what we currently practice, those are the states that effectively claim derivation. And so
let me just cut in. Let me cut in there, Mr. Yomi. Yes. So this committee, this fiscal and tax reform policy committee, would you say that they've been able to, the understanding of the derivation principle for states, do a thorough work to ensure that it's equitable and it's just, dousing all those fears raised by northern states? We've seen two northern governors raise their own concerns, and northern leaders saying a lot about the whole scope of the tax. Tax derivation principle.
That's correct. That's actually what the committee attempted to resolve. But I think what created the uproar is that when the derivation percentage, which was meant to address those two challenges I mentioned, which is the state, I think it should be completely our own. We needed to ensure that there is some bit of fairness to show that more is ceded off to them. When that percentage was suggested to be increased from 20 to 60, the states that were complaining about the lopsidedness of what was called derivation data, they assume it is still the same basis of allocating VAT to headquarter states. All right. That's how you're going to share the 60%. And so they got angry. We were complaining that when it was 20%, majority of the VAT were credited to Lagos State and Rivers State, for example. State. So, but what the bill actually proposed is a different way, or a correct way, or fairer way of actually attributing consumption and derivation, such that you no longer just credit one company VAT return to one state. Each company that files VAT return is supposed to accompany it with the spread of that services or the sale of that goods all across the country. And what you will expect, even though there is no perfection, but what you will expect is that rather than one single state claiming derivation, every service, product, name them, each company is expected to then furnish how those goods and services were sold across. So the idea was each state would take benefit of the economic activity that is coming within the state, and so an extra percentage from 20 to 60 was meant to then compensate and assure them that they are able to actually enjoy derivation the way it should be. So that was the whole arrangement. I think somehow the headline, that derivation has moved from 20 to 60%, just triggered this concern that, the problem we have been sitting on will continue, which is the fact that it's like saying Rivers State and Lagos State will have the percentage increase from 20 to 60%, because that's how it appears to them. And I think the whole public sensitization and stakeholder engagement and the conversation, I'm hoping that if indeed that is really the concern, some of the facts and the explanation that are coming to the public glare now will help to assuage their concern, and they will every state will actually realize that they stand potentially to benefit more from this than either the current arrangements or the possibility of states going to the court, to win the case to 100% administer VAT in their respective state, which will not be good for anybody. Not many states will benefit of that. And even more importantly, the taxpaying community will be worse off, because we're now going to be charged with the responsibility of
complex issues.
Answerable to 37, or in fact 36 different state internal revenue services, FCTIRS, and the federal government with respect to international taxes and VAT on import duties and all of that. We think that was part of the complaint that the taxpaying community had over the complexity and the complications of tax system. So that was what informed the proposal, and I'm hoping that, the chairman and everyone who has spoken have also been honest enough to say, look, there is nothing that is perfect. If there are different suggestions, different parameters, that let's bring it forward, and those things can always be tweaked.
Definitely, the engagements are very important. It's past second reading at the Senate level, so this engagement is very critical, and sensitization is very, very important across board on the whole issues around VAT and what states are accrued and why this is a landmark. It's commendable what these reforms have brought forward, and it will definitely transform the tax landscape. But let's look at something interesting that says that states will be exempted from tax for bond issuance. Prior to now, when states go to the market, they pay tax. So can you elaborate further on this? Because this is a very good development. We've seen that there's been this laxity in states engaging and leveraging the capital market, which is a platform for long-term financing.
Absolutely. No, absolutely. So, this is there are quite a lot of very innovative ideas that are contained in this bill, and this is one of the reasons why many of us that have insight into what the bill contains, and I've taken time to read it and also understood, how many years we have taken in complaining about the issues. We're so interested in making sure that, concerns are addressed and that this bill can still come through. So one of it is the one relating to bond by state. So prior to now, most of the pronouncements and the exemptions and the waivers that we've had when it comes to the capital markets or fundraising have been largely by the federal government. And so there is first sometimes the lacuna or the gap that exists when states are approaching the capital market or the bond market to be able to raise funds. So the question is, does this is a federal government. So from a technical perspective, when the federal government says bond issued, is exempted, technically you will say it relates to the bond that is issued by the federal government. And we think we are in a state where many states are also approaching the capital market, and individuals and corporates are seizing the opportunity to provide finance and to take position in those bonds. And so we need to eliminate that gap and provide an even or a common advantage that holders of federal government bonds are having, so that state government bond holders of those can also have the exemption. So that's why the exemption is meant to clarify and even the space and make the benefit that is available to federal government bond holders also available to state government. So clear provision that when state government issued bonds, the similar type of withholding taxes exemption that is applicable when it was previously pronounced by the federal government will also be applicable to the state government. And we know how much of an impact that will mean in deepening the capital market, in ensuring that holders are also able to take tax benefit and advantage. So there's no discouragement and there's no ambiguity. There is no disincentive, and that's what that provision is meant to be. And we think it's one of the very important provisions that will excite the capital market and the tax-paying public and the investing public, particularly.
Definitely.
I don't want to say if, when the bill eventually gets passed.
Definitely. Just in 1 minute, the issue of non-state actors, this has been a major issue over time. When you talk of ease of tax payment, we've discussed this before several times when we had this conversation. How would this address it? And the issue of no consultants. I know that issue was raised in a recent town hall by a sister television platform, and they said no consultants. So will this whole reform, especially at the VAT level, address non-state actors? That's one of the major concerns at subnational level. The prevalence of non-state actors has actually been at the state and the local government level because of the administration of the multiple levies and charges, and all of that. So what the reform had attempted to do is to consolidate all of those charges, and the state and local government are supposed to repeal all of those laws that created the entrance of non-state actors. So when this bill gets passed, we have all of those laws already consolidated. There's an harmonized levy that is going to be charged, and so this will help sanitize the space and make sure that the administration is centralized and to eliminate all the interferences we're having at the non-state actor level. And the same, you also asked questions relating to technology and consultancy. The whole idea is to allow technology, to underpin the administration for the efficiency, for the effectiveness, for the depth, that we're looking for. So a lot to be excited about the bill than the few issues that seems to have dominated the public debate and discourse. So in 30 seconds, as we wrap up, Mr. Yomi, what is the way forward to build consensus to ensure that this consequential reform really is a win-win situation for everyone? There's no fear, there's no concern that the one part is affected, the other part is advantage. Yeah.
I think the way forward is to just continue this engagement and sensitization. Quite a lot of people who were apprehensive at the beginning, we are beginning to have more openness to engage and to be able to express concerns on specific aspects of the law that they have concerns with. And you will hear the president has already asked the office of the Attorney General, for the Federation to look into specific sections and provisions of the law that people are unhappy with or certain sectors are unhappy with. And let's tweak those and make changes that would appear to be more fair. So it's more engagement, more consultation, and with a view to making sure that all concerns are addressed.
Thank you very much, Mr. Yomi Olugbenro. This whole bill and proposed, these 4 bills, from what I've gone through and seen, is a very robust one. Last time in our history, we've had very robust fiscal framework. It's been over 3 decades. And this time we have an opportunity to change the entire tax fiscal landscape and make it more equitable, resourceful, and productive for everyone. So we can just say that we need to continue the engagement and find a way to get everyone on board, build that consensus. Well, thank you very much, Mr. Yomi Olugbenro, West Africa tax leader, Deloitte. You don't also want to tell us, but of course I have to say you're part of this wonderful committee, Fiscal and Tax Policy Reforms Committee, chaired by Mr. Tawo Yedede, has done this great work. And we just hope that the whole gamut, everything is taken in and we are better for it as a country. Thank you once again for the time.
Thank you so much. My pleasure to be with you.
Thank you. To our viewers, if you want to get further insights on this conversation, visit the ProShare website displayed on the screen and follow our social media platforms to engage further on this program. Until we come your way again, enrich yourself with knowledge of socioeconomic developments around you, it is wise. I'm Ottoabasi Abasiekong. Thank you for watching and bye for now.